Okay, folks. I know my mic is working. It's just that you're until the sound subsides, you can't hear me. So I'm going to start by asking a couple of questions, and I'm really doing this to kind of nag you. How many of you are not part of a group? Let me repeat that again. How many of you are not part of a group yet? Really? Every one of you is in a group? Okay. How many of you have not picked a company yet? Let's be honest, it's okay. No, I want the numbers to go down over time, obviously. How many of you have not picked a company as your company to value? Okay, so here's all I'm going to say. Pick one soon, right? So no, obviously we're still early in the class, but the longer you put this off, it doesn't get any easier. So pick one soon. Any other questions before we get started? One final point I want to emphasize. If you're a non-Stern student, you have an at nyu.edu email, it's entirely possible that you're not getting the emails for this class because Stern, when you join a Stern class, you're automatically given a Stern email. So the Gmail, the Google group that they create for this class is based on those Stern email addresses. So if you're not getting an email, it's probably because it's going to that Stern email address. So there is a way in which you can see what that address is, and you need it not just for the emails, but also to access the databases that Stern has, to sign on to the Google shared spreadsheets if you're having trouble. That's probably the reason. So you can't sign into those sheets with a Gmail address or with a so try to see if you can get the Stern email address so that you can take advantage of resources. So no questions, let's get started. Today, we're going to start to delve into the details of valuation. And we're going to start simple. To value something, you need to get a risk-free rate. Now, it sounds fancy, but you need to know what you can make on a guaranteed investment before you get all ambitious and say, what will I make on a risky investment? So today, we're going to talk about risk-free rates. And in the process, we're going to crack what I call the currency code, which is a lot of people misunderstand currencies. But today, hopefully by the end of the class, you'll have a better sense of what drives or doesn't drive currencies. So I'm going to have a series of questions for you to kind of, and as I said, the answers will be in the class. So if you're a little confused right now, you don't have the answer, don't worry about it. Let's say you're valuing a Brazilian company, but you're doing the valuation in, and you have a choice. You can either value it in Brazilian reais, or you can value it in US dollars. The risk-free rate in reais is 7.5%. Let's say the risk-free rate in dollars is 2.5%. Okay. So this is a very simplistic question. Give me a gut feeling now. So same company, same point in time, same financials. You can value it in reais. You can value it in dollars. The risk-free rate in reais is much higher than the risk-free rate in dollars. Which of these two currencies would give you the higher value of the company, if either? You want to try?
Yeah. First principle, it shouldn't be either of them because valuation should be dependent on currency.
Okay, that's not a first principle. That's almost, I hope it's true. So, based on what you'd like to do, you're right. You don't want the numbers to be different, but it looks like the discount rate in reais is going to be much higher than the discount rate in dollars. Everybody agree? Because you start at the bigger base. And aren't higher discount rates going to lead me to lower value? So today we're going to talk about why what you call the first principle is going to kick in, because at first sight, picking a currency with a higher risk-free rate should give you a higher discount rate. And by itself, that seems like a bad thing for value. Yes. I think that's the other half of the equation, your cash flows. But then what exactly happens to your cash flows to offset the discount rate effect? You got to start to become explicit about what is it that causes risk-free rates to vary across currencies. If it's growth, then you're in trouble, because then how can you have a high growth company in one currency and a low growth company in another currency? So when you say growth, are you talking about nominal growth?
Yeah.
Nominal growth, which means it's not growth, it's why are the differences in nominal growth? The real growth is the same, inflation. Today, we're going to isolate the inflation effect on currencies, and that's going to be a very healthy thing. Let's move on. If you have to, there are some people who believe in what they call real valuation, so their practice doesn't always reflect that. For the longest time in Latin America, people would refuse to value their companies in local currency terms. Why? Because inflation was high, they couldn't handle it. They said, we're going to do everything in real terms. What does that mean? Well, you're going to do your, when you do your analysis, you're going to ignore inflation all the way through. So let's again ask this very generic question. If you value a company in real terms, you're going to get a different, should you get a different value? Let's get that out of the way. What do first principles tell us? It shouldn't be, right? Same company. What does it matter whether you do real or nominal? Today, we're going to talk about what would you do differently when you value a company in real terms, because you're now ignoring that inflation part of the growth that gives you this first principle of it doesn't matter. Our end result is we want it to not matter, because if your company comes out with different valuations, depending on the currency you pick or nominal, real, you're in deep trouble, right? Because how do you decide a company is cheap or expensive? Let's keep going. Take the T-bond rate, right? It's gone up and down. Right now, it's more towards the up level. But for the bulk of the last decade, US Treasury bond rates have been at historic lows. And if you ask most people, or if you watch CNBC too much, and that's damaging to your brain, stop. Okay. But if you do, what is the wisdom you walk away with? Why have rates been low for the last decade? Because the Fed has kept them low. We're doing what? Quantitative easing, QE1, QE2, Titanic, whatever you want to call it, basically, that they've been doing all this neat stuff. That's why rates are low. I mean, if you listen to people long enough, it seems like the Fed controls rates. In fact, we're heading up to an FOMC meeting, Federal Open Market Committee meeting. In fact, today might be the day, right? Everything on Wall Street comes to a complete stop. All eyes are towards the Fed. Why? Because at least in terms of theory, what they do at the meeting is going to drive rates for the next few months or year. So what I'm trying to get a sense of, how much power do you think the Fed has? And again, for the moment, give me your gut feeling on setting rates, because you listen to the people on CNBC, they must be setting rates right now. And if they want to bring the rates down, they can. If they want to raise the rates, they can. So I wanted to start thinking about what are the rates the Fed actually sets, and how does it play out in your treasury rates, the T-bill rate, the T-bond rate, the mortgage rates, the corporate borrowing rate. Because again, I think there's a lot of mythology about central banks that we need to dispense with. One final point. This is perhaps no longer true, but about a year or two ago, start of 2022, there were at least 3, maybe as many as 5 currencies where the risk-free rate was negative, and it freaks people out. It freaks people out for good reasons, right? In an econ class, whenever you see an interest rate, it's always a current, you never see negative interest rates. I remember the first time negative interest rates started showing up, 2015, 2016. I get emails from people saying, what do we do now? And they can understand why people are uncomfortable with negative risk-free rates. But are negative risk-free rates impossible or just unlikely? Clearly they happen. So what fundamentals might explain negative risk-free rates? We talked about inflation. Let's get it. So inflation is 2%, 3%. Can inflation be minus 3% a year? In fact, what do we call that? Deflation. Today, we're going to talk about how when you have low real growth and deflation, negative risk-free rates come out of this. Negative risk-free rates are not a sign of health. They're a sign of deep damage in the economy. There are 2 parts of the world where we had negative risk-free rates for a long period now. One is Japan, and the other is much of Europe. You know what they share in common? You have aging populations and potentially shrinking economy. No economy is being able to grow while its population is shrinking and aging. It's just the demographics work against you. So today we're going to talk about what to do when you have negative risk-free rates, because in Europe, I'll tell you what people did. They started replacing, they said, it's a minus. Let's just take the minus out. I feel much more comfortable now. Can we do that? Can we just drop off a sign because we don't like it? This would be great, right? We're doing a money losing company. Act like the minus is not there. Your company just becomes a money-making company. So we have a lot on our plate today to deal with. So let's get the process started. So let's turn back to your notes. I think we were on page 13 of your first lecture note packet. So I am going to share again. So we're going to start laying the foundations for discounted cash flow valuation. I'm going to say something obvious, but take it for what it's worth. For discounted cash flow valuation, you need a CF and you need a D, right? A discount rate and a cash flow. In fact, every discounted cash flow model, those are the combinations that make for it. So let me set up the process on what a generic discounted cash flow model will look like. You're going to start with the most recent year. You're going to project out expected cash flows in the future. You're going to discount it back at a risk-adjusted rate, and you're going to come up with the present value. There's one little mechanical problem I'm going to run into. If you remember, I said the value of an asset is the present value of the expected cash flows on that asset over its lifetime, right? So if you have a 10-year asset, you do 10 years of cash flows, 20-year asset, 20 years of cash flows. When you buy shares in a publicly traded company, at least in theory, how long is its lifetime? When you open a corporate charter, tells you when the company is founded. It might not be forever, but there is no finite ending point, right? It could be 20 years, it could be 50 years, it could be forever. So to value a company, what do I have to do? Estimate cash flows forever. This sounds like my vision of hell. An Excel spreadsheet that never ends, right? Year 1, year 2, year 3, year 3,555, and you're going and going and going. We can't do that. That's why the constant refrain here in valuation is, can I stop now? How about right now? And I have an answer, and you're not going to like my answer. I say you can stop if you're willing to make an assumption. The assumption you have to make is beyond that point at which you stop, your cash flows have to grow at a constant rate forever. You know what that buys you? It buys you an infinite series in mathematics. 200 years ago, mathematicians solved for the value of the series. We stole it in finance. We act like we invented it. But this is this famous terminal value equation you'll see at the end of every valuation. It's basically the present value of all cash flows beyond year 5 or 10 with that equation. But for that to work, your cash flows have to grow at a constant rate forever. It's the most misused part of valuation. Because you can already see, looking at the equation, how many games you can play. So one of the things we're going to talk about is how to keep that number from running away from your valuation. So generic DCF, you have cash flows. Your cash flows grow at a constant rate forever. You have a discount rate, you take the present value. But how you measure cash flows, and that's what we talked about last class, is also going to determine what discount rate you use, right? We talked about equity versus a firm. So let's start with the 4 measures of cash flows you could potentially, if you look at cash flow, 3 measures of cash flows you can use to do valuation. The first is, you can say, look, I don't want to be estimating cash flows. It's too much trouble, too many estimates. I'm just going to look at the cash flows the company actually returns to its shareholders. In a purer sense, that's the only cash flow you actually get from the company as an equity investor, right? Everything else is kind of on paper. The dividend discount model is the oldest discounted cash flow model out there. Let me ask you, are you valuing equity or are you valuing the firm when you do a dividend discount model? Equity. So the discount rate has to be the cost of equity. Your growth rate has to be a growth rate in dividends, and your terminal value will occur when your dividends start growing at a constant rate forever. But do companies pay out what they can afford to in dividends? It's kind of, you see, how the hell do I know? There's actually proof in every company's balance sheet that tells you that companies don't pay out what they can afford to in dividends. And what is that proof? Go ahead. The cash they have in the balance sheet. How the heck does Google end up with 100 billion in cash? It's not manna from heaven. It's a direct reflection of the fact that year after year, they've chosen not to pay out. I'm not saying it's good or bad, but I'm saying what companies pay out is set by management, but it might not match what they could have paid out. So the second way to do valuation is not trust the dividend, but to estimate what the company could have paid in dividends. And guess what? It's very simple to do. How much can companies afford to pay in dividends? Whatever's left over after they've met every conceivable need, CapEx, working capital. And it's all there in the statement of cash flows, right? You can see what's left. We're going to come up with a measure of potential dividend that we're going to call free cash flow to equity. Kind of a fancy name, but this is what they could have paid out. So the second approach to valuation is to take those potential dividends, replace the actual dividends with those potential dividends. So a company like Google, which pays no dividends, now you'll be discounting something. Your growth rate will be the growth rate in free cash flow to equity now, rather than in dividends. And when will you stop estimating cash flows? Is when that free cash flow to equity starts growing at a constant rate forever. So as I go through these different approaches, I want you to think of both what you do in common across the approaches and what's different. So dividends and free cash flow to equity are both equity valuation approaches. One uses actual dividends, one uses potential dividends. The third approach, of course, is step back and say, I don't care just about the equity. I care about the entire capital providers, both debt and equity. Look at the collective cash flow they make, cash flow to the firm. But the discount rate now will become the cost of capital rather than cost of equity. And your growth rate will be growth in free cash flow to the firm. And you'll stop estimating cash flows when that growth rate approaches a growth rate that can be sustained in perpetuity. Every discounted cash flow model shares the same structure. The only difference is what you define as cash flow and the discount rate that goes with it. So if I were to draw a dividend discount model, my task is very simple. I'll start with the existing dividends. And for those existing dividends, I'm going to look at dividends as a percentage of earnings. It's called a payout ratio, but everything is built around projecting the dividends that this company will pay. And I'm going to discount them at the cost of equity. And what I get as a present value is the value of equity in that company. There are still people who hold on to this model. The problem is a smaller and smaller part of the market fits into this model because fewer and fewer companies pay the kinds of dividends where you look at the dividend and say, that's pretty close to what they could have paid out. Maybe phone companies like Con Ed. A free cash flow equity model looks exactly the same, but you have a little more work to do. Instead of trusting the company to pay out what it can, for the moment, don't worry about the equation. We're going to come back and flesh them out. I'm going to estimate the free cash flow equity, the cash left over after every conceivable need has been met. A post-debt cash flow. I'm going to estimate a growth in that free cash flow equity, discounted the cost of equity, and what I get as a present value will be the value of equity in the company. And in fact, since I'm doing the calculation, I'm going to separate cash from everything else. Do you see why I want to do this? Remember we talked about keep things as simple as you can. Why mix in cash with everything else and try to value cash when we know what the value of cash is? So here I have the luxury of saying, I can value all of the non-cash equity in the company and add the cash at the end. I get the value of equity. And then, of course, you got the most generic version of the model. I estimate a pre-debt cash flow. And as I said, again, don't worry about the equation. We'll come back and talk about the specifics of how we come to, but these are pre-debt cash flows. We discount them at the cost of capital. And what we get is a present value. And I want you to listen carefully to the next statement, because it's going to create a lot of follow-up, cleaning up to do, is the value of the operating assets of the company. Let me repeat that again. When you take free cash flow to the firm, which you start with operating income and you work through, you value the operating assets in the company. What have you not valued? You haven't valued cash. That's the same thing as previously. But if you have cross holdings in other companies, you haven't valued those as well. So a whole lot of cleaning up to do to get from value of the firm to value of equity. So put all three pictures next to each other so you can see what you're doing in common, what's different, because that's the consistency issue, making sure that once you've chosen a path, you stay on that path. So I'm going to describe the process by which we do valuation. And the reason I'm going to generalize is we all go through this process. How much attention we pay to each stage of the process differs across people. So let's say you picked a company. What's the first step? What's the next step for you once you picked a company? You're going to go collect the data. What does that mean? You're going to get last year's financials, year before. It's so easy to do it now, right? You go to, in fact, I sent you that link to S&P Capital IQ. Please get on as soon as you can. It's an amazing database. You can pull up 20 years of cash flows in your account, every single line item in the accounting statement. It's going to save you a huge amount of time. You're going to collect historical data. Then what are you going to do with the historical data? You're going to pore over, look at it. But remember, when you look at the historical data, you're doing it not because you like to look at historical data. Yeah. What the heck is going on here? Okay. You're doing it because you want to get some questions answered, which you can use to project. It's all about the future. So the only reason we're looking at the past is to get better clues about the future. In particular, as you look at past data, there are three questions I want you to try to answer. How quickly has my company grown in the past? Right? My suggestion is focus on revenues because income can be all over the place. How quickly has my company grown in the past? Second, how profitable has my company been in the past? You can look at operating income, you can look at EBITDA, you can look at net income. And the third question you're looking at is how much has my company been reinvesting to get this growth in the past? It's all in the past, but you're trying to get those questions answered because those are going to be the questions that drive your forecast in the future. Now, if you have a company like Coca-Cola with 100 years of financials, there's obviously a lot you can extract from the financials. If you have a company like Peloton, there might be very little you learn. Don't beat yourself up. That's what it is. But we start with the past, not because we want to stay stuck in the past, but we're looking for clues for the future. So you assess the past, and then you try to forecast the future. I'm going to give you the two generic forecasting ways of doing this, depending on the company you have. If you have a company with stable operating margins, you know what that means, right? They're earning about 12% of revenues as margins. It looks like they've settled in. They're a mature company. Your job got a lot easier. Why? Because you can take operating income and forecast it out. If your margins are stable, why bother forecasting revenues? You're going to multiply it by 12% every year. You're going to end up with the operating income anyway, so start with operating income. And with stable margins, you get an added bonus. Your expected growth in the future is going to be a product of how much you reinvest and how well you reinvest. Because you can't grow if you don't reinvest. If your margins stay stable, then your income will not grow if your revenues don't grow. And for your revenues to grow, you got to take new projects. So reinvestment measures how much you put back in the business, and how much your operating income will grow will depend on what kind of returns on capital you make on that investment. I'll give you an example. You invest 50% of your money, you make a 20% return on capital, your expected growth in operating income is going to be about 10% a year, 50%. It's a very neat and mechanical way of doing valuation, but it works because your margins are stable. We'll talk about the algebra that makes it work. But with stable margins, you can start with operating income, use reinvestment and returns to forecast cash flows in the future. That will work in about 10% of all companies. Why? Because most companies, margins are shifting. They're going up, they're going down. Your margins might be negative right now. There you have no choice but to start with revenues. Because there you got to forecast out revenues first. So with Tesla, you saw me forecast out revenues, and the revenues go to 4. And Tesla right now, actually, you can get away using the stable margin assumption because I kept the margin stable. But if you believe margins are going to go up or down, you're going to have to forecast what that margin will look like for next year, 2 years out, 3 years out. Revenues times margins gives me operating income. Last step, I'm going to look at what I need to reinvest to get that revenue growth. But my end game is still free cash for the firm. How I get there is different in the two scenarios. So I start with the past, I project out, I forecast out the future. And how long do I have to keep forecasting? Till I get to a point where I'm willing to tell you that this company will grow at X% a year forever. I'm going to call that a mature company. A mature company in this class is a company that grows at a rate less than or equal to the growth rate of the economy. And I'm also going to make the statement, and I'm willing to back this up, that every company, no matter how high growth it is, will eventually become a mature company. You know why? It's a scaling problem. You get bigger and bigger and bigger. At some point in time, you're going to hit a wall. I've heard this over my 40 years. I've heard people to look at a company. This company will never be a mature company. I heard that about Walmart in the 1980s. Because it was an incredible growth company, an amazing company, until it got to about $500 billion in revenue. So it took $500 billion before it hit the wall. In contrast, Groupon hit the wall at $10 billion. Why? Smaller, competitive advantages, lots of players in the game. Where you hit the wall is where you put the company to stable growth. And that's going to be a judgment call you have to make with your company, given its business, what do you think about the company? So I think Tesla will hit the wall around 400 billion. Why? By then it'll be one of the 5 largest companies in the world in terms of revenues, the largest automobile company in the world, even with the other businesses. And I'm saying, you know what? $400 billion, you're going, and it's not a bad end, right? You're growing at the rate of the economy. So I'm not saying you're going to end and die as a company. I'm saying from this point on, you're just going to keep track with the economy. So we'll come back and flesh out the mechanics, but I want you to understand the process. You start with the past, but don't get stuck in the past. You forecast the future, but don't punish yourself. Am I getting this right? And at some point in time, you put closure and say, at this point in time for my company, I'm going to be a mature company. And along the way, of course, you got to discount these cash flows at a discount rate that reflects the riskiness of the company. I'm going to lay the foundations for how to think about discount rates. I come to you with a young, money-losing company. Just think in common sense terms. Should I have a high discount rate for this company or a low discount rate for the company? I should probably have a high. It's a risky company, a high discount rate. On your spreadsheet, tell me what you're doing to your small money-losing company. If you follow my tracks, you're making a small company into a big company, money-losing into a money-making company. You think from a common sense perspective, the discount rate should change as you go from this young money-losing company? Absolutely, right? Do you know that in 95% of discounted cash flow valuations, you see one discount rate and it never changes? In fact, there are some appraisers who are shocked. You really can change discount rates over time? That should be the rule, not the exception. Maybe if you gave me a company that's already mature, I can get away using one discount rate. But how can I value a company that's evolving and changing and not see the discount rate change? So for the moment, I'm not going to dive into the mechanics of risk premiums and betas, but I want you to keep the door open of whatever approach used for discount rates. That approach has to be flexible enough to allow you to change your discount rate as your company changes over time. So let's review the steps. Start by looking at the past. That's going to be your most comfortable time in this project. Why? Because it's all there. You can blame the accountants if something goes wrong, right? Start with, but the test for you is, are you willing to go from there to the forecast? So it's assessing a discount rate, coming up with cash flows, putting up closure. And in each of those stages, you have no choice but to make estimates. And please don't view subjective as a curse. It's so subjective. Of course it's subjective. How can it not be subjective? Because you're looking at the facts and making it better. If that's your definition of subjective, be glad it's subjective. Because if it were not subjective, why would you need to take this class? Right? You could build a model that automates everything, or use ChatGPT to do your evaluations. It's good that it's subjective. Be glad there's human intervention, because otherwise, why bother? So today I'd like to start on the process of the D in the DCF. Let me ask you an obvious question. Does the D matter in DCF? Of course it does. That's why I said DCF. But it matters a lot less than you think. Even before we start talking about discount rates, I'll tell you what a healthy valuation should involve in terms of time breakup. Probably spend 10 to 20% of your time estimating discount rates and 80 to 90% on the cash flows. That's what a good valuation should look like. You know what a banking valuation time breakdown is? 70 to 80% of your time is spent estimating discount rates. And then towards the very end, say, oh my God, I don't have cash flows. Let me make up some crap. When you're going to screw up on a valuation, and I'm not saying that's a good objective, it's going to be because you got the cash flows wrong, not because you got the discount rate wrong. Of all of the assumptions I made on Tesla, the one that I least care about is the cost of capital. You want to make it 9, you want to make it 11, go ahead. To me, the bigger assumptions are about the market size and the margins that I'm assuming. That's what's driving the valuation. Yes. Because it gives you a false sense of control. Discount rates, we have a lot of data. In fact, we can outsource the data. We use Duff and Phelps equity risk premiums, get the risk-free rate from the, it's a great way to pass the buck and say, hey, it's not my fault. It's where we go because we want to be comfortable. And again, in this class, I want you to get away from the places where you're comfortable and get to the places which make you uncomfortable, because that's where valuation battles are won or lost. So let's start talking about discount rates. First, let's lay the consistency point that we started last class. If you have equity cash flows, it should be the cost of equity. If you're trying to discount cash flows to the firm, it's got to be cost of capital. Today, I'm going to add on 2 more consistency rules. If you estimate your cash flows in a specific currency, your discount rate has to be in the same currency. So if you decide to do your analysis in Nigerian Naira, your discount rate has to be a Nigerian Naira discount rate. Some horrendous mistakes can be made when you mismatch cash flows and discount rates. And third, if you decide to do your valuation in real terms, then your discount rate has to be a real discount rate, not a nominal discount rate. Real cash flows have no currencies attached to them, right? It doesn't matter. It doesn't matter. When you're doing things in real terms, you've kind of taken out the currency effect, the inflation effect. So to do all of this, we go back and lay the foundations for discount rates. So when you think about the risk-adjusted discount rate, there are 3 ingredients you need to get to a risk-adjusted. The first is you need a risk-free rate, whatever currency you're doing your valuation. You cannot do valuation without a risk-free rate. Second, you need to measure what the price of risk is in the market. What are people charging for investing in equities? What's the default spread? And third is you need a measure of how risky your company is relative to the average company. So you need a risk-free rate, you need a measure of relative risk, you need a measure of the equity risk premium. Today, we're going to focus almost entirely on the risk-free rate. Should be the easiest of the 3, right? But before we do that, though, let's talk a little bit about risk. I mean, one of the things I would like you to do once you pick your company, and this is cathartic, so do it just to make yourself feel better. List out all the things you're uncertain about. And guess what you're going to find? You're certain about nothing. There's no facts, it's all estimates, right? But after you've listed every conceivable thing that you're worried about, I want you to start putting things into buckets. See, what are you talking about? Here's your first choice. Is it estimation uncertainty or is it economic uncertainty? Estimation uncertainty is uncertainty you feel because you haven't collected enough data. So you don't know how many electric cars are sold right now. That's estimation uncertainty. You go dig, you can find that information somewhere. Estimation uncertainty is uncertainty you can reduce by doing more work, collecting more data. Economic uncertainty, basically, it's about the future. What percentage of the automobile market in 2032 will be electric? You can do some research, but the bulk of this is out of your hands, right? It'll depend on the price of oil. It'll depend on what governments do. Who knows? You know, people's tastes, technology shifts. Here's why I want you to separate the two. Estimation uncertainty, I said you can reduce by collecting more data, doing more research. You know what happens to economic uncertainty? As you do more research, you actually get more uncertain. There's a time in valuation, I call this the karmic point, where you basically say, I've done all I can, I need to move on. I want you to recognize that point because otherwise you're going to frustrate yourself trying to collect data. Stop using Google search. There's a point at which it gets counterproductive, and it's much sooner than you think. Economic uncertainty is out of your hands. It's kind of let go. 90% of the uncertainty we face in valuation is economic uncertainty. That's why spending days, then people ask me, aren't you spending 3 weeks on evaluation? No, after 24 hours, it's counterproductive. There's nothing I'm learning by collecting more data at this point. It's just to make myself feel better. Estimation versus economic uncertainty. The uncertainty can be micro uncertainty or macro uncertainty. Micro uncertainty is uncertainty you feel about the company. In the case of Tesla, what are all the things you're uncertain about? What will Elon Musk do tomorrow? What about day after tomorrow? Will the Shanghai plant be allowed to open in 6 months? Micro uncertainty. What's macro uncertainty? What will inflation do? What will happen to oil prices? You're saying, why bother? Macro uncertainties are the only uncertainties you build into discount rates. You know why? Because micro uncertainties cut in different directions for different companies. You know the law of large numbers in statistics? I pick 100 companies. The micro uncertainties, 50 companies will do better than I expected. 50 will do worse than expected. Things will average out. Macro uncertainties don't average out because they're all cut in the same direction. If the economy goes into recession, I don't care whether you have 10 companies or 100 companies in your portfolio, you're going to feel the pain. So macro uncertainty is going to discount. So when people talk about adjusting the discount rate for the Musk effect, they're missing the point. It's not designed for that kind of risk. And finally, you have discrete uncertainty versus continuous uncertainty. I'll give you the easiest way to see the divide. Let's say a US company with revenues in a country with fixed exchange rates. There are fewer and fewer countries where this is true. You know, fixed exchange rates, you know what's true, right? Every day you wake up, you look at the exchange rate. It's the same as it was the day before. This is good, right? There's no uncertainty. There's no uncertainty. There's no uncertainty. And then one day you wake up and what do you see? An 80% devaluation. That's discrete uncertainty. In contrast, think of a US company with revenues in Europe. Every time the dollar-euro exchange rate changes, your cash flows are changing, right? Continuous every second of every day. As a business, which of these two uncertainties do you think are easier to incorporate into your analysis and plan for? Continuous and discrete uncertainties. Almost everything in finance is built around continuous uncertainties. We're very good. All of the risk and return models in finance are really about continuous uncertainties. The uncertainties we're not very good at are dealing with are discrete, like bankruptcy, nationalization, a CEO going into rehab, regulation. We're terrible at dealing with it because we're using the wrong tools. The tools we need are statistical tools, right? What's the likelihood of it happening? This class, we're going to talk about both continuous and discrete uncertainties. And I'm going to argue that discounted cash flow valuation as practiced now often ignores discrete uncertainties, that you're overvaluing startups. You know why? Even if you do everything right, you know what you're missing? What happens to 2/3 of startups? They don't make it. You can't adjust the discount rate for it. It's not designed for it. So continuous and discrete. Go ahead.
I would discount rate supposed to like reflect the risk?
Because your investment is part of a portfolio. This is the next thing we're going to talk about. When you look at risk, you got to look at the risk through the eyes of the marginal investor in the company. If you have all your money in Tesla, God help you, then you have no choice. You're saying, I'm exposed to micro and macro, but that was a choice you made. And guess what? The market doesn't reward people for making bad choices. We can come back and talk about what we do when this is not true. But when you look at risk, at least in terms of how we think about risk, how we think about risk in valuation is we're going to make a contention, I'll back it up, that not all risk gets built into discount rates. Because if you're a diversified investor, I'm not talking about somebody with 5,000 different companies, 15, 20, 25 companies, the way you think about risk has to be different than somebody puts all the money in one company. That's why micro uncertainties don't get built into discount rates. You're saying, what if I'm a private business owner, I'm putting all my wealth in a company? Then you have a point. Then micro uncertainties have to come into discount rates. We'll talk about mechanisms. But in general, bringing micro uncertainties into discount rates for publicly traded companies is asking to be rewarded for something you shouldn't be rewarded for. I'll give the analogy, a really stupid one, but take it. Let's say you buy a house across a 6-lane highway. And your brokerage house where you trade is across the highway. So every morning, here's what you do. You wake up, you drink a lot of coffee, and then you run across a 6-lane highway, very busy highway, to make it to the brokerage house. And then you say, look, I take a lot of risk every day. I should get at least a 50% return on my portfolio. You know what the answer to that is going to be, right? Live on the other side of the highway next to the brokerage house. This is your fault. And when people who are not undiversified demand to get rewarded for micro risk in publicly traded companies, say, look, you made your choice, but don't expect the market to reward you for it. Maybe you're so good at assessing companies, you can make up for that risk. But that risk is still there. So not all risk counts. And when we think about the risk in a company, I don't mean to belittle you, but it's not your risk or my risk that we should be thinking about. It's the risk of the marginal investor in the company. You say, who the heck is the marginal investor? The marginal investor is the investor who sets prices. I don't affect prices. When I buy 1,000 shares of Apple, no matter how much I wish upon that trade, it doesn't change the price. So to be a marginal investor, you need to own millions of shares, not thousands of shares, and trade those shares. So if I took Apple, who do you think the marginal investor in Apple is? It's not you, it's not me, it's not an individual, it's probably BlackRock or Vanguard or State Street. It's an institution. Follow up. Is Apple the only company in the portfolio? I hope not, or they're a very strange institution. The investors who price stocks tend to be investors with multiple stocks in their portfolio, diversified portfolios. But that's going to be different in Tesla. Not really. It's not like Elon Musk is trading millions of shares every day. The price of Tesla is being driven by institutional investors, just like Apple is, because they're the ones setting the price each day. So when we look at risk, we look at the risk through the eyes of marginal investors who are diversified. And at least in valuing publicly traded companies, that's why we stay with only that part of the risk you cannot diversify away. That's why I said macro risk, inflation, interest rates, real GDP growth, and how it shows up in your discount rate. I am not going to spend even more than a couple of minutes on risk and return models because I have bigger fish to fry. But every risk and return model in finance is built on what I just said, the assumption that investors are diversified. The only difference then becomes, how do you measure non-diversifiable risk? In the oldest and perhaps still the most used risk and return model in finance, the CAPM, we make the assumption that investors are supremely diversified. The marginal investors. You know why we do that? Because in the CAPM, we make two assumptions. And to see what those two assumptions are, think of why most investors stop diversifying. Even those who are not stock pickers, think of the two reasons you stop. One is there's a transactions cost, right? It's tiny, but as you get more and more stocks in your portfolio, the marginal benefits of adding that stock become smaller and smaller. So there's And if you're a stock picker, you also think you can pick the right stocks, right? So the two reasons we stopped diversifying are transactions costs, and we think we can pick stocks. Know what the CAPM assumes? No transactions costs. And what it euphemistically calls no private information, which is you have no idea what's cheap, what's expensive. If I take the two restrictions away in the CAPM, you know what your portfolio is going to look like, right? You're going to keep adding and adding and adding until you have a little bit of every single traded asset in the market in your portfolio. Sounds absurd, but think of it as an index fund that owns a little piece of everything. We're not that far away from having something like that accessible, right? I think there's a Vanguard global index fund that has like 5,000 companies in it. You can conceive of an index fund that owns a small piece of everything in the world. And you invest in that index fund. It's actually the rational way to invest if you have no private information, there are no transactions costs. In the CAPM, that's where you end up. What should we call that portfolio that has everything in the market? Well, let's call it the market portfolio. What a creative title. We all end up holding the market portfolio. So in the CAPM, guess how we measure risk? We measure risk as the risk added to that market portfolio, and it's captured with one number, a beta. Every time you use betas, remember you're carrying all of that baggage of no transactions cost, no private information with you, but it does give us this compact model, risk-free rate plus beta times. I'm going to call that number in the brackets an equity risk premium. CAPM came out in 1964. Since then, of course, there have been other models, the arbitrage model, pricing model, the multi-factor model. They're all variants of the same theme. The only difference is instead of having one beta, they might have 5 betas. In the arbitrage pricing model, the factors are unspecified. In a multi-factor model, the factors are specified, but the end game is the same. You have a risk-free rate plus a measure of relative risk, that's what beta is, and a risk premium either for one market portfolio for each factor separate. But every one of these models starts with a risk-free rate. Later on, we'll come back and talk about betas and risk premiums, but let's start with the risk-free rate. So in the CAPM, you need a risk-free rate. In the arbitrage pricing model, you need a risk-free rate. And in every one of these models, you need measures of relative risk and equity risk premiums. So our task is laid out for us, right? To build up to a discount rate, we need a risk-free rate. We need measures of relative risk, or betas if you prefer to call them. And we need measures of equity risk premiums. So I'm going to start with the very simplistic definition of a risk-free rate. On a risk-free rate, you're going to know exactly what you're going to make, guaranteed. Let me repeat that again. When you invest in something risk-free, you know exactly what you're going to make. To show you the connection between risk-free rates and time horizon. First, for something to be risk-free, there can be no default risk in it. Not even an iota default risk, because something can default, you're not guaranteed the return. So let's say there's a default-free entity. Let's make the US Treasury, for the moment, assume it's default-free. Let's say over a 1-year time horizon. You buy a 1-year T-bill. Right now, I think the rate is 4.37%. So today you buy the T-bill. In fact, I put some of my money in T-bills yesterday at 4.37%. A year from now, I come and knock on your door and ask you, what did you make on the T-bill? What's your answer going to be? 4.37%. It's a risk-free investment. But let's say today you bought a 10-year T-bond. 3.88%, 3.9%, or whatever it's at now. That's the interest rate right now. I come back 1 year from now and knock on your door and say, what did you make on the T-bond? Part of the return is guaranteed, right? The coupon. But what's the part that's out of your control? What could happen to a 10-year T-bond over the next year? If interest rates change, what happens to the price of your bond? Remember, there's a remaining life on the bond. There is this legend of US Treasuries being a safe haven. I've heard this enough that it terrifies me. Because there are people who say, I put my money in US Treasuries, everything is safe. You know what the US 10-year T-bond had as a return last year? The so-called safe haven. So nobody's read my data update 3 yet, huh? Is about minus 18%. So worst year in history for the 10-year T-bond. Why? You started the year at 1.5% T-bond rates. You ended the year at 3.88% T-bond rates. Think of the repricing effect. It actually stocks were down 18%. Those are return stocks. Bonds were down 18% as well. That's why you had a 60, 40, 70, 30, 80, 20 portfolio. It doesn't matter, right? Minus 18, minus 18. What does it care what the weights are on the two? So what I'm trying to say is for something to be risk-free, there can be no default risk. You can also have no reinvestment risk. If you have a 10-year cash flow, don't be using T-bills to discount that. It's not risk-free. Because if you use a T-bill, you know what you'll make for the next 3 months, but then you have to roll it over at a rate you don't know now. So a 10-year cash flow, you want a 10-year, preferably a zero coupon bond, right? Because if you have coupons and you got to worry about reinvestment, you can already see that risk-free is not that simple, even if there's a default-free entity around. So first, time horizon matters. So when you ask me what the risk-free rate is, I'm going to refuse to answer until you tell me over what period. You want a risk-free rate for the next year? I'm going to give you a different answer than a risk-free rate for the next 10 years. Second, if you ask me a risk-free rate, I say, what currency? Oh, Turkish lira? I'm going to give you a very different answer if it's Turkish lira than if it's US dollars. And third, we've been trained, and this is true when I was taught finance, and it's true still in many classrooms, that if you have a government bond rate in a currency, that it is default-free. Is that true though? What is the logic that's given for why government bonds in the local currency are default free? Why is the Indian government viewed as default free when it borrows in Indian rupees? They can print more money. That's the logic that's always been used for explaining why government bond rates are default free. But that's an empirical question, right? They can, but they might not. You know that half of all sovereign defaults in the last decade, last 50 years, have come on local currency government bonds. The Russian government in the late 90s defaulted on its Russian ruble bonds and paid off its dollar bonds. Tells you something about how the Russian government views its own domestic borrowers, but that's a story for a different day. But companies do default even if they issue bonds in the local currency. Why might that be? If it's so easy to pay off the debt, why would you choose to default when you can print the money and pay off the debt? Yes. If you print the money and pay off the debt, it's true you've avoided default, but you've debased your currency, right? And here's the practical question. What's easier to come back from? Because a government that defaults is damaged. But a government that debases is also damaged. I'll give you an example of how much damage inflation does. In the late 90s, 1997 was the first time I went to Brazil. I did a valuation seminar, 2 days. The only question anybody asked through the entire 2 days was about inflation. Nobody wanted to talk about companies, returns on capital, what's inflation now? You know why? Because in the early 90s, Brazil had hyperinflation, 5,500% inflation. And people basically lost faith, lost trust. And the way this manifested itself was no Brazilian entity, including the Brazilian government, was able to issue long-term bonds in reais for almost 15 years after hyperinflation. Because would you want to buy a 10-year bond issued by a government in reais if you've been burned? Nobody wanted to. It took the Brazilian government, I think 2006 or 2007 was the first time the Brazilian government issued real-denominated bonds. Coming back from currency debasement is really difficult. People, because remember, fiat currency, what do you have? You have a piece of paper in your hand. What's behind it? A central bank and a government. If you trust neither, you're saying, that's just a piece of paper. I actually have $100 trillion note. Don't get too excited. It's Zimbabwean dollars. No? I think I might still have it here. Looks great. I think for purposes of glamour, this is what it looks like. $100 trillion. I almost did that. Remember that example where I put it in the note? If I put in, how much would you pay for that? It was worth about 40 cents 4 years ago. It's worth nothing now. That's what happens with inflation. 100 trillion. When you have 100 trillion on a note, you know you've lost the script, right? You imagine going into a store You buy groceries and they say, that'll be 500 trillion today. It'll make you feel really rich to be dishing it out. No? But you're poverty stricken, you're living in a hut. You can basically can't make it. It takes a long time to come back from the basement. So that was Brazil, it took them 15 years. In contrast, think of Argentina. In any just world, nobody should ever lend to Argentina ever again, right? This is a country that manages to find a way to default, what, every 5 years? But I remember 2016, I was invited to this equity investors conference, portfolio managers from around the world. It was the third or the fourth coming of Argentina that I've seen in this century. We're back again. 4 years later, you default again. We're back again. You know what Latin America has taught us about inflation, and everything we know about inflation we've learned from Latin America? It's easier to come back from default than it is to come from debasement. And countries have taken that to heart, which effectively means that government bond rates are not necessarily risk-free. So here's what I'm going to do to kind of disentangle risk-free rates. I'm going to give you a series of tests, and I want you to think of the answer. And each of them is pretty common sense as we go along. Think of the answer. And along the way, we'll encounter every conceivable question you can run into with risk-free rates. So let's say you're doing a valuation. Remember, in valuation, you're projecting cash flows, not just for the next 5 years or 10 years, but what do we do after year 10? That cash flows continue forever, really long term. You're trying to come up with the risk-free rate to value a company in US dollars. You've done your cash flows on a valuation. I'm going to give you choices, and you tell me as I go through whether this would be a choice as a risk-free rate. Okay? A 3-month T-bill rate, what's wrong with it? Your duration mismatching, right? Your cash flows are forever, 3-month T-bill rate. A T-bill rate should never, ever be used in a DCF valuation. About 1 in 5 DCFs that I see use the T-bill rate as a risk-free rate. Already you've lost the script, shouldn't be there. What about a 10-year T-bond rate? A little better, right? But if you give it a choice, there's also a 30-year bond. And that seems like it's even better because your cash flows don't stop at year 10 and go on forever. If I had to just pick a risk-free rate in US dollars, and that was my only estimation challenge, I'd go with a 30-year bond. But as you look at all the valuations I will do this semester, I'm going to stay with the 10-year bond. And there are 2 reasons. The 10-year bond is always the freshest of the long-term bonds. It's the one bond that gets auctioned off every Monday. It's the most traded of the bonds. The 30-year bond, some strange things happen. It attracts, Japanese insurance companies that want to lock in coupons. You often get this strange quirk. And there's a second reason why I stay with the 10-year bond. This is just the start of my process. After I get a risk-free rate, what do I need to estimate? Default spreads, equity risk premiums. And I have to estimate them relative to my risk-free rate. You know how I get default spreads? I look at corporate bonds and then I compare the rates on those corporate bonds to a T-bond. If I make my risk-free rate a 30-year T-bond, I have to find 30-year corporate bonds. That's really difficult to do. My estimation life becomes a lot simpler if I go with a 10-year bond. So I'm going to stay with the 10-year bond. And if you were insisted that you want to use a 30-year bond, I'm going to let you go ahead and deal with adjusting the risk premiums and default spreads. It can be done, but I'm going to stay with the 10-year bond rate. You think, what about the TIPS rate? You know, the TIPS rate is, right? It's an inflation protected treasury bond. Right now, it's about 1.5%. Why would people buy 1.5% TIPS when you can buy a 3.88% T-bond? What do you get with the TIPS? How does it work? You get the bond, you get a 1.5% rate. You know, but what do you get actually as a coupon each year? If your inflation is 3% that year, you get 1.5 plus 3%, 4.5%. If it's 8%, you get 9.5% as your coupon. It's a real rate. File that away. Right now, I don't want to use it because my valuation is in nominal dollars. But maybe when I do a real valuation, remember I want to take inflation out, this could come into play. As for choices E and F, please don't go there. Don't sit there and say, this is the highest number. I want to be conservative. No, this is not the way the world, that valuation is supposed to work. You can't pick the highest number or the lowest number because there's nothing holding you apart other than maximizing or minimizing the discount rate. So if I'm doing my valuation in US dollars, I'm going to go with the 10-year T-bond rate. And the only reason I use the 10 versus the 30 is because the rest of my estimation gets easier. Any questions? But while I'm doing all of this, am I making an assumption about the US Treasury and default? I am, right? What's the assumption I'm making? They're not going to default. That used to be an easy assumption 15 years ago. Now it's debatable, right? In fact, in 2012, it became a very open question to debate because S&P lowered the rating for the US from AAA to AA. Not a terrible rating, it's still a really good rating, but they opened the door saying, you know what, there could be default risk here. And now, of course, there's talk of, the next debt limit coming. So, hey, there might be a time when we might not be able to use any of these treasury rates as risk-free because there might be defaulters. We'll talk about what to do then. But for the moment, we're implicitly assuming that the US Treasury will not default. Yes.
I emailed you this question as well, but why do we never consider the probability of success and probability of failure and calculate a probability weighted rate for it?
But risk-free rates?
No, just for rates in general, right?
We'll come back to that. I mean, clearly, that's not, if it's risk-free, that wouldn't come in, right? There's 100% probability. That's why we call it risk-free. Implicitly, anytime you do an expected cash flow, we are taking expectations across scenarios. But remember, the world is not a discrete place. It's a continuous place, right? It's not like I can say the world has 3 scenarios: deep recession, shallow recession, recovery. So the problem with probabilities and scenarios, they're designed for, so with Brexit, we can talk about probabilities. But when we talk about the economy, where you have a continuum from -3% to +3% for the economy, it's really a continuous distribution. If you ask me, why do we not bring in distributions? We could. In fact, we will, when we do Monte Carlo simulations, we will bring in entire distributions. But don't assume that that's going to make your valuations better. Again, it'll force you to face up to your uncertainty. And that's all it'll do. But it's not going to qualitatively make your valuations better. It's just going to give you a much better sense of the range you have around your value. Okay. Let's move to a second test. Anybody planning to value European company? Let me be specific. Company in euros, a German company, a Greek company, a Spanish company? Nobody? Yeah, who you value? Don't worry, I won't put you on the spot. A Portuguese company? Oh, Porsche. So Porsche, German company, right? Really a multinational that happens to be part. Good company to value. So you want to value the company in euros, you project the cash flows in euros, you need a risk-free rate in euros, right? So you go looking for a government bond rate in euros. The only problem is you have a luxury of riches here. You have a dozen different governments, all of whom issued 10-year bonds denominated in euros, and the rates are all different. So let me put you on the spot. Which of these rates would you use as your risk-free rate? Yeah, you got it because convenient German company, but did you pick the German rate because your company is German? What if your Porsche were a Spanish company? My questions are always good. I like the day. Yeah. You see where I'm going, right? It's in euros. Why are these rates different in different? Why do different governments have different rates? Why does the Greek government have a higher 10-year rate than the German government? There is default risk, right? And what do we say about a risk-free rate? It cannot have default. So you know what? I would use the German euro bond rate as my risk-free rate, whether I'm valuing a Spanish company, a Greek company, or a German company. I know part of you saying, but I want to punish this company for being Greek. I'll give you plenty of chances to do that. Don't do it in the risk-free rate. So you value a company in euros, just take the German euro bond rate, and not because it's German. 10 years from now, if the Portuguese euro bond rate is the lowest, miracles can happen. You'd use the Portuguese 10-year bond rate. It's the lowest of the 10-year bond rates in euros. Let's up the ante. Are any of you valuing Indian companies in Indian rupees? Nobody wants to put their hand up. You're planning to value an Indian company? Who are you planning to value? Reliance. Okay. Good luck. with that. No, it's like Ambani with a different twist on it. No? So let's take Reliance. You want to value a company in Indian rupees, you need an Indian rupee risk-free rate. The Indian government does have a 10-year bond denominated in rupees. In fact, at the start of 2023, the rate on that bond was 7.34%. It's good, right? I've got my risk-free rate. But before I use it as a risk-free rate, what do I need to check? Is there default risk in that bond? Remember, we said governments can default. And here I'm going to cheat. I'm not a macroeconomist. I can't sit there assessing default risk. So I went to Moody's, not the sharpest knife in the door, but at least the numbers are free to get, but they have sovereign ratings for every country. You know how they rate companies, they rate countries. And actually they report 2 ratings for every country, a local currency rating and a foreign currency rating. The foreign currency rating is the risk they see in India when it borrows in dollars or euros, Japanese yen. The local currency rating is the default risk they see in India when it borrows in rupees. I hoped and I prayed that I would see a AAA rating. If I had, you know what I'd have done? I'd have used the 7.34% as my risk-free rate in rupees and blamed Moody's if something went wrong. What I saw instead was a Baa3 rating, much better rating than it used to be 20 years ago. But what is Moody's telling me? There is default risk in this bond. The 7.34% is not a default-free rate. In terms of an algebra problem, I have a government bond rate, but it's not default free. To make it default free, what do I need to do? I need to take out the portion of that rate that's due to default risk. I'll take you through a longer journey on how to come up with this default spread. But the default spread that I came up with in early 2023 for this bond was 2.69% based on the rating. So Baa3 rated sovereign bond has a 2.69% default spread. So you ready? I have the government bond rate, 7.434%. I have a default spread of 2.69%. My objective is to come up with a risk-free rate in rupees, and I'll give you the choices. I can be stubborn and say I'm just going to use the 7.34%, which is what 90% of Indian analysts do. It is use the government bond rate. It's a government bond. It's almost unpatriotic. Somebody accused me of being so, well, how come you're being so unpatriotic? I said, this has nothing to do with patriotic. If I have to worry about default risk, it doesn't matter whether an Indian default, no, it doesn't matter who's defaulting, it's Indian, German, I still don't get my money back. But that's a stubborn outlook. You take it. I could add the 2.69% to the 7.34%. Would that make sense? Sounds like I'm double counting, right? Or I can take the 2.69% out, which would give me a risk-free rate in rupees of 4.65%. That's what I'm going to do. My risk-free rate at the start of 2023 in Indian rupees is 4.65%. You know why I do this? Because if I don't do this, I think we're going to end up double counting country risk. If I use the 7.34% and I call it the risk-free rate, you know, when I get to my equity risk premium, what you're going to be tempted to do, and say it's an Indian company, I'm going to use a higher equity risk premium. This is my process for keeping risk where it's supposed to be, in the risk premium, and the risk-free rate cleans up for the defaulters. So let's talk a little bit about that spread, right? Because without that spread, you can't come up with a risk-free rate. Yeah. You don't have to, right? That's a good question. Why am I not doing this? Why not take the Greek default spread and net it out of the Greek euro bond to come up with the risk-free rate? Because there's actually a default-free entity that's issuing the bond. So the same reason, if you ask me for a risk-free rate in US dollars, because you're valuing a Brazilian company, I'm going to not take the Brazilian government denominated in dollars and subtract out a spread. I'm just going to go directly to the risk-free rate. So if you can have an entity which is AAA rated, that's issuing bonds in that currency, you're home free. It's only if you don't that you have to do this cleaning up. So let's talk about how you can come up with this. So 2.69% came out of right field, left field, middle field, somewhere from out there. So where do you come up with that? So I'll give you the 3 ways in which you can get default spreads. One is if your country issues dollar or euro denominated bonds. You compare the rate on that bond to a USD bond, and that difference will be a default spread. The Brazilian government, for instance, issues dollar-denominated bonds, 10-year bonds. I compare that rate. So that gives me a default spread. That's the first. The second, and this is a fairly recent development, I'm sorry, I'll come to you, In the last 20 years, you have a market called the sovereign CDS market. Fancy name for a market where you can go buy insurance against default risk if you buy a Brazilian bond or an Indian bond. So think of it as a market set estimate of the default spread in a country. So sovereign CDS spreads, you can observe what the spread is for India, and that becomes your default spread for the country. And the third is, if you cannot get the first two, you can tell me a rating for the country. I created a lookup table based on other countries with similar ratings and said, this is what the typical spread looks like. So I'll go through all three with the Brazilian government so you can see what it works out to. But you had a question, I'm sorry. Oh, sorry. That's okay. So let's take Brazil. Let's suppose your job is to assess the default spread for Brazil so that you can use it to come up with the risk-free rate in reais. My first stop is I go find a dollar-denominated Brazilian bond. This started 2023. The dollar-denominated bond is 6.15%. The T-bond on that same day was 3.88%. They're both dollar bonds, 10-year bonds. One is has default risk, the other doesn't. The difference between those two, 2.27%, becomes the default spread for Brazil based on a dollar-denominated bond. So file that away. The first approach to measuring default spread for Brazil gives me 2.27%. But for this to work, what has to be true? That country has to have either dollar or euro bonds so that you can compare to something risk-free. A lot of East European countries, for instance, have euro bonds that you can compare to the German bond to get a spread. If I wanted to get a default spread for Greece or Spain, I can do it with the German bond. But you need a risk-free entity in that bond. Here's the second, the sovereign CDS market. There are about 75 countries right now on which you can go buy insurance in this market. So the way to think about this, as I said, is a market estimate of what the default spread for a country is. At the start of 2023, Brazil's sovereign CDS spread is about 3.52%. That's how much you'd have to pay each year. So if you're buying a Brazilian bond, you want to buy insurance, you go to this market, they'll take away 3.5% or whatever you earn from this. That's actually higher than the 2.27%, right? We'll talk about why the sovereign CDS market and the ratings can diverge. But at least at the start of 2023, the sovereign CDS market saw more default risk in Brazil than the ratings agency did. But there's one flaw with the sovereign CDS market, which is it's an insurance market with counterparty risk. You know what counterparty risk is? You buy insurance, but you're not guaranteed that the insurance will be delivered if the counterparty defaults. In fact, in 2008, when Lehman went bankrupt, it was a big problem because they were a big player in the sovereign CDS market. They'd sold insurance. In fact, a lot of good that does. You'd have bought insurance from Lehman for the 2008 crisis. So the way, what that also means is the spreads you're getting might not actually be default. There's noise. And here's the kind of shortcut that I use to clean up for the noise. According to the sovereign CDS market, there isn't a risk-free entity in the world. There is no country with a zero sovereign CDS spread. I think the country with the lowest sovereign CDS spread might be Switzerland at the time I did this, 0.17%. But even Switzerland is, are you really worried about default risk in Switzerland? That suggests to me that there's some friction in the market that means this number can never drop below. So for the last few years, here's what I've done to clean up for it. I take the US, which usually is towards the low end. In fact, started 2023, it was probably higher than it's been historically relative to countries like Switzerland or the Netherlands. I take the US spread and I subtracted it out from the sovereign CDS spread, saying, look, part of this is friction. I want to get rid of it. So we clean up for it. The spread you come up with for Brazil is 3.2%, 3.52 minus 0.32. So there's somebody keeping track, 2.27% from the government bond, 3.52% if I want to go with just the sovereign CDS spread, 3.2% if I go to this cleaned up CDS spread, which brings me to the last where you could get a default spread. Remember I said there were 75 countries for which there are sovereign CDS spreads? There are about 180 countries in the world, maybe 200. There are lots of countries for which I cannot get a sovereign CDS spread. There are no dollar bonds. I'm kind of lost, right? India, for instance, doesn't have dollar denominated bonds. It did not have sovereign CDS spreads until about 5 years ago. But it did have a rating. So there will be countries where you can get a sovereign rating, but you can't get the other two. And if you can give me the sovereign rating for your country, I can tell you based on the start of 2023, other countries with similar ratings, what the default spread should be. And a BA2 rated rating, which is what Brazil had, would give me a default spread of 3.68%. So 2.27% from the government bond market, 3.2% from the CDS market, 3.68% based on the rating. The Brazilian 10-year REI bond, I think, had a rate, we'll come back and talk about it, had a rate of like 10.5% or 11%. Which of these three numbers you subtract out will give you a very different risk-free rate, but I'm going to say something very weird. Doesn't matter which one you pick, just stay consistent. If you lower numbers, your risk-free rate will be higher, but that number will now become part of your equity risk premium. So whatever you pick will have opposite effects in your risk-free rate and risk premium. But what will get you into trouble is if you use two different measures of default spreads, one for your risk-free rate and one for the risk premium. What about a real risk-free rate? I've kind of given away the answer. You're doing your analysis in real terms. This has nothing to do with dollars or reais. You want a real risk-free rate. The TIPS rate is a real risk-free rate. You see, but it's in dollars. No, there is no dollar in a real, right? It's a real risk-free rate. The currency kind of dissipates. You put me anywhere in the world and ask me to do a valuation in real terms, I'm going to start with the 1.53%. But I'll tell you the assumption I've made that might make you uncomfortable. You know why there should be only one real risk-free rate across the world? Because if I have a real risk-free rate of 1.5% in the US and 5% in Brazil, if capital can flow freely across countries, you know what's going to happen, right? It'll flow out of the US into Brazil. In a world where capital flows freely, there can be only one real risk-free rate across the globe. But practically, we know capital doesn't flow freely. So when you go into a small emerging market with barriers to capital, you're in Myanmar, you could have a real risk-free rate of 4 or 5 or 6%, which is disconnected from the global real risk-free rate. But in most of the world, you can use the TIPS rate as your risk-free rate. I'm going to leave. I'm going to stop there. But when we start on Monday, we'll talk more about what else drives the risk-free rate.
When we last back on the money about the sell side and buy side of the buy, and I was thinking about if on these ratings like AAA, AA,